the LTV still 70 or was it lower?
Can you just call him when we're done? It's my turn to ask a question. Damn it. Well, what is up, everyone, and welcome back to How to Invest in Commercial Real Estate. And today we are super excited because we have a guest on the podcast. I love talking to new people about commercial real estate. It's one of my favorite things. Nothing to add on that. That's great, guys. Appreciate that. Out here alone in the cold,
I thought you were going to provide some intro to the show. Hey, we're still raising money for Petromax. We need your money, $12 million. Brian's not going to eat until we raise it all. I thought we went over that.
Yeah, that is great. There's a lot to unpack there, but yes, we are raising money for our new Petromax sale leaseback acquisition. Massive 15 gas stations we're acquiring. This is a super cool offering because it offers a ton of extra depreciation. We think that could go even higher based on the legislation right now. And then, we're raising $11 million. Brian decided that he's not going to eat until we raised it.
If you want to see Brian eat, then you have to send in money. Otherwise, I don't know what's going to happen.
Brian's not going to eat. That's what's going to happen.
Oh, I'll eat.
Anyway, for Brian's sake, take a look at the offering. It's super interesting. I think you're going to like it. Okay.
All right, moving on.
Enough of that. Over to our guest based in Gaffney, Alabama. We have Grant Reeves from Stoic Equity Partners. And this is a cool guest because I love having people on that do different stuff than us, right? So light industrial, a lot of people like to do light industrial. A lot of people that I know anyway. It's a hot asset class right now. So without further ado, Grant, tell us a little bit about yourself. Tell us about Stoic. Tell us how you got into commercial real estate. Give us a scoop.
Yeah. So thank y'all for having me on today. Good to see you guys. So as you mentioned, my name is Grant Reeves. I'm the co-founder and managing director of Stoic Equity Partners. We are based in South Alabama, down on the Gulf Coast, and specialized in multi-tenant flex industrial value-add acquisitions. Started out in commercial real estate right after college, went to Auburn University, and right after that got into the brokerage world here in the Mobile area. Really did a little bit of kind of generalist stuff for a while. Ended up with a specialty really in limited service hospitality. And so we're selling like Hampton Inns, Holiday Inn Expresses, all that kind of fun stuff. Mainly a lot of owner users, some kind of larger funds, REITs, that kind of thing, but did that for a long time. Ended up at Marcus & Millichap at their national hospitality group, worked there actually I was a licensed broker there until about 2 months ago, but was a really bad broker once I started Stoic. So it was a little bit different, but yeah, so how Stoic got to be is Jeremy Friedman, who's my 50-50 business partner in Stoic. We were longtime brokers together and worked at a firm prior to me going to Marcus. Had always stayed friends, that kind of thing, talk deals. And in 2019, I had decided I really wanted to get on the principal side, start raising money, doing my own deals, whether that was developments or acquisitions, or I didn't really have the strategy I wanted to go after at that time, just kind of was looking at everything. Learned how to model, how to underwrite different JV structures, LP, GP structures, all the kind of fun stuff that we do now. And so spent a lot of time reading every book I could find, every YouTube video, really figuring that out. Fast forward to 2020, COVID hits, and Jeremy and I were just kind of talking one day, and he brought up a building that he had come across, and it was, nothing in brokerage was going on at this time. So we kind of delved into looking at what the opportunity was there. And he was like, man, I really think this is a cool deal, but I have no idea how to structure, JV, LP, how to raise money, how to legally that structure looks or anything. And I was like, well, fortunately for you, I've spent the past year of my life figuring that out. So that can be a great resource. So we did that first deal together. That ended up being Stoic. We decided we kind of wanted to build an enterprise around that. It started off as just kind of that one deal is what we were going to do. And we kind of built that now to where we are today. We have 13 properties. About 900,000 square feet, about 87 million in asset value that we've done. The first deal we did was self-storage, went on to do a few more self-storage deals and then transitioned into flex industrial.
So talk to us real quick. I'll interrupt you. Talk to us about, we're a little bit familiar, but our audience might not be. What is flex industrial? What can it be? What kind of businesses does it serve? Just to give them a baseline for what kind of asset class you're in.
For sure. And we call it flex industrial. Some people call it class B industrial, shallow bay industrial, contractor garages. They're all kind of under that same umbrella. but essentially it's office warehouse complexes. So 50 to 150,000 square foot building made up of a lot of, I'd say 2,000, 5,000 square foot office warehouse suites throughout. Buildings we really prefer are they have kind of office front, so maybe like a brick facade or stucco facade on the front, just kind of look like a regular office building. On the rears, you have roll up doors or dock high doors, which is your warehouse entrance.
Typically metal frame.
A lot of metal frame, but also tilt up construction as well. A little bit of both.
Okay.
We prefer tilt up. It's just obviously a lot more expensive, and you don't really get any better rents for it. So usually the numbers work better on metal.
So typically we see these as maybe not quite office buildings, but more of a hands-on industrial type company that's got either machine shops or maybe auto detailing or some area where they want an office, but they also need space to do whatever it is they do, maybe even warehouse product that they're going to sell or something like that. That's why it's called flex, is that it's open to a bunch of different uses depending on what's needed by the business.
Yeah, for sure. And you see a lot of different layouts. I mean, you'll have certain tenants that need 60% office and some that need 10% office, and just for varying different degrees of what they do in that space. That is one of the reasons we like flex those, because if you need to have a large portion of your workspace be warehouse, you cannot go work over Zoom, and it kind of protects that whole work from home trend, obviously, that you see in office space, which has been really detrimental to that asset class. We do see a lot of crazy different tenant mixes, though. I mean, we have Terminex in a lot of ours, which is pretty mainstream. A lot of general contractors, a lot of HVAC, a lot of plumbers. What else do we have? A lot of gyms, but also you get into some more obscure stuff like labs. So we have a couple of pharmaceutical type tenants that do IVs, they do prescription drugs and do compounding, that kind of thing. So their warehouse is actually lab space. We have Tyson Chicken, that is a tenant of ours that does food safety. So they test all their packaging and salmonella and all that kind of stuff. So again, their whole warehouse is all built out as lab. And then you have just kind of some traditional industrial tenants like UPS, FedEx, that are using it as logistics centers too. Then e-commerce is another big one that we're seeing more and more of a trend of. We have a decent amount of those tenants already, but like people that are, like we have one in Mississippi, and it's an Instagram boutique, and these girls are sitting in there all day taking pictures of women's clothes and selling them on Instagram and shipping them out of the back of the warehouse. So it's really diverse. But yeah, that's exactly what you said. That's why they call it flex, because it serves so many different tenant mixes.
Grant, is there something you like about industrial? You said you had experience in hospitality and self-storage. Is there something about industrial that you prefer over those other asset classes, or you've just sort of kind of moved into this particular area?
Yeah, we didn't really, we always liked the flex piece of industrial, just based on the supply demand metrics is really how we found ourselves there. In most of the markets we play in primarily like secondary cities in the Southeast. That's gonna be like Memphis, Tennessee, Jackson, Birmingham, Alabama, places like that. Nobody's really built any flex. So that's kind of how we ended up there in the first place. But specifically why we like flex is just based on the fact that it can fit just about anybody. I mean, it's the cheapest space in town. E-commerce can do well there, as well as more heavy industrial uses. So when you have a product that can serve so many different options, you're not really tied to one industry doing well, which is a big reason that we were drawn there too.
Yeah, that makes sense.
I like that. I got some questions on the metrics. So you're out, you're trying to find a new asset to syndicate or buy for yourself. What kind of cap rates are these types of properties going for in today's market? Is there a number, a sweet spot for you guys where you're just like, okay, if we can get it at this cap rate, we know we're going to be able to get the cash flow that we want?
Yeah, so I mean, we are value add, so like we'll buy stuff that are 4 caps that we can get to 12s yield on cost. So I mean, it is a little bit all over the board, but for the most part, for like a more stabilized deal, we bought a 160,000 square foot portfolio in Mississippi last week that was a 770 cap. That was kind of more of a core plus deal. I mean, it was value add, but it was a pretty stabilized deal. So I feel like it's a good benchmark around an 8 is to answer your cap rate question. But what we're looking for usually is the ability to buy it around I'd say around a 6 or a 7, with the option to be able to get it over 10 within 2 or 3 years. A lot of legacy.
Sorry, I interrupted you. Well, the value add play, is it more occupancy increase, or you come in and say, hey, these rents are $8 a foot, and I think they should be 11 or 12?
Yeah, it's much more rate. Occupancy, there's pretty much no vacancies of flex that we play in or that we see. I mean, it'll be a lot of deals that are 100% occupied. Like we have one in Colorado, Arkansas. When we bought it, it was $4.56 rents. We're signing leases at $8.50 a year later. So I mean, we're doubling rents there. But you do have some that are more of a vacancy play. Those are buildings that are built out with too much office. So you kind of have two different sides of the coin. So you have the rate play, but then also like we've bought some deals that are 70s or 80% occupancy. And that's because all the vacancies are built out as 100% office. So you can go in there, tear out that office, turn it back into 50-50, 60-40 office warehouse, and shoot up the occupancy really quickly, which is another good strategy that we've done.
So where would you say is the best place to find these opportunities?
We have a good broker network. We were prior brokers, so obviously we knew a lot of brokers already in the marketplace. But the thing about flex is it's a little bit different than even what we used to play in hospitality. Like hospitality brokers, like we worked all over the country. I sat in Alabama, I sold stuff all over the place, but I was very specialized on one product type. Flex Industrial is very localized to each market. So like the Memphis brokers, they really only work Memphis. So they'll be a national firm like a Cushman Wake, but they're only working Memphis. And so getting into the markets that you want to be in, meeting the brokers that are running with flex space on the lease side, management side, as well as the investment sales side, making sure they really understand what you're looking for is really how we've been able to find deal flow. So we buy most stuff through brokers, but off market.
Nice. Okay, so what is the debt?
I love this.
Yeah, I do too. What does the debt look like on this kind of stuff? Let's say you're buying 7 cap and you think you're going to be able to value add the rents. What's the going in debt?
So usually it's regional bank debt. So these are like $5 to $10 million deals, so a little bit smaller. So we're usually 70% LTC. We'll have a construction loan component depending on how much lift is there. A lot of times we're redoing roofs, we're redoing stucco, doing parking lots. We'll have a decent amount of TI money on the front end just to be able to refresh space or rip out office like I was talking about. So so we'll go in 70% LTC. Current rates are 8s is what we're seeing. 25-year AMs, year or two of IO, depending on how long the turn's going to be. Usually, like if it's going to take us, I'd say 3 years to stabilize an asset, we're trying to get 3 years of IO. Sometimes that's more like 18 months, 24 months, but as long as we can get. I will say on the larger, more stabilized stuff, like that larger portfolio we bought in Mississippi, I mentioned, that was life insurance debt at a 5.85 rate. So that one worked out really well. But it
was the LTV still 70 or was it lower?
Can you just call him when we're done? It's my turn to ask a question. Damn it. Come on.
Jump in here, man. Come on.
Okay, so a 4 cap value add deal, we're trying to get it over 10, right? And it said 13 properties, 87 million in transaction volume. I mean, that's a ton of deals in a short amount of time. You guys are shitting and getting. Where is the money coming from? Tell us about like your fundraising, and then what does a normal offering look like? And just like that 4 cap, and it takes us 3 years to stabilize it, and it's 3 years interest only. Tell us about the cash flows through that period, and when you underwrite your IRR, and a little bit about that.
Yeah, for sure. So starting off, the first 10 deals that we did were all single syndications. And so we started out friends and family money, just like most people do, and have expanded that more into some more family offices, some more kind of quasi institutional money. But those are all deal by deal syndications. Last fall, we decided to go more of the fund model. And so we started SCP Industrial Holdings 1, which is currently raising a $25 million raise. We're at 7.5 right now. But those 3 properties we bought last week were through the fund. We had some JV partners directly in each deal, so we were able to bring in some equity from a JV partner, some equity from the fund to be able to right size the portfolio. But yeah, on the fundraising side, I mean, just like everybody, we started out with old real estate clients that we knew that liked to invest in real estate and raising $50,000 checks, and we're still doing that. We love those guys, love people that write $50,000 checks, but we also have some larger family offices that write $2-3 million checks, which is also really nice. That's really a big push for us right now, is just kind of getting that out there and letting people know what we're doing. Because I mean, y'all are in the business. Fundraising is as important as the real estate side, right? That is a large portion of our effort. We have a team behind us to be able to do that. So we have in-house analysts, We have accounting in-house, asset management in-house, investor relations in-house, and then Jeremy and I running the firm. So I mean, to be able to grow to that size that quickly, we need to have a good team around us. So that's been a big focus as well. When Jeremy and I first started the firm, we kind of felt like you need to be kind of like a deal shop, which like a couple guys, maybe an assistant out there running and doing your own deals, or you can really build kind of more the enterprise side of things. We went more of the enterprise side of things. Sometimes that's a headache, so we wish we would have gone the other direction. But for the most part, it's good, so we like it.
So what do you think the metrics of the fund are? Like, what are you pitching right now on that first one?
Yeah, so we're targeting 7 to 8% cash on cash over a 5-year hold period, and so that's average. So these are value add deals. So year one will be like 4 or 5%. Year 5 will be like 9 to 10%, which will average back in the mid 7s. IRR 15, 16 overall. Equity multiple 1.7, 1.8. But to get there, we're blending different properties. So we'll buy like that Jackson portfolio has an investment through the fund in that, and so that's 8.2% cash on cash pretty much throughout the entire life of that 5-year hold period. But for also then there's that 4-cap that I was mentioning. That's a McDonough, Georgia deal. We're buying that for $64 a foot, or we bought that for $64. I guess bought that 2 days ago. So sorry. But bought it for $64 a square foot. Average rents in there are 5, market's 12. It'll take about 3 years to turn over the rent roll. So that one really won't see any cash on cash return or any distributions off of that one specifically until I'd say month 30, month 36, somewhere in that range. But when we pair that up with like the Jackson portfolio that's spitting off 8% in year one, we can kind of be able to hit our metrics the way we need them to. I mean, obviously value add, your biggest thing you're looking at is equity multiple and IRR, but being able to deliver cash on cash throughout that hold is obviously very important to a lot of people.
So what's the exit strategy of the fund? I'm assuming the equity's locked up for the entire term. How do you see liquidating all of this?
Yeah, so it's a 5-year closed-ended fund. So total portfolio size with JV partners like myself will probably end up being around $100 million. We will group together portfolios in geographical locations. So we own a bunch of stuff in Jackson, so we'll probably group all that together and sell that off to one larger group if the market's there for that. This is not a play where we're going to roll up a portfolio of assets scattered throughout the Southeast and sell them to one large group. That'd be great if we can. That's just not really an opportunity we currently see in the flex industrial space. It's a little bit more localized still and not institutionalized enough to be able to say, hey, we're going to sell this whole portfolio of Memphis, Jackson, Birmingham assets to one group. But yeah, so we'll start selling probably midway through or right before about midway through year 3, year 4 to be able to give us enough time to divest of all those assets as well, so that we're hitting the target to be able to close out December of 28 is when we have it closed.
Are you guys doing the fund management in-house? Or are you guys utilizing like NAV consultants or somebody else like that?
Yeah, we use Juniper Square as a fund administration and portal access. So we have those guys, and we have third-party audits as well every year. So we have in-house accountants, but we also have a third-party audit that overlooks everything too.
Yeah. Well, man, you're doing awesome stuff. I mean, I'm really impressed, and I just want to, hats off to you. In the short amount of time, I mean, I feel like we've done a lot in 2019, and talking to you, I mean, it's awesome. Yeah. You're doing some awesome shit. So
how do people get a hold of you if they watch the podcast and they want to get more information? What should they do?
Yeah. So my email is greaves, so GREAVES at stoicep.com. So STOICEP.com. Our website also has that. It's stoicep.com. I am on Twitter. I need to be more active on there, but it's Reeves_Grant. I'm also on LinkedIn. I don't know my at LinkedIn, but I am on there. If you Google me, cool. Love to connect with you.
Yeah.
Well, good. If we run into any flex space, we will hit you up for your advice, and maybe we can partner on a deal.
Love to. We love to do co-GP deals. We love to do JV deals. So yeah, love to work with you on it. Please let us know.
That'd be awesome. All right. Well, we will see you guys next week for the podcast. And Grant, thanks for hopping on. It was amazing meeting you.
Good luck.
Yep. Congratulations on your success. Yeah.
Thank you, guys.
All right. Bye-bye.
All righty. See you next week.